what are your thoughts on how banks are using this as a strategy, especially when it comes to their income? Because I've spoken to a number of CEOs, and what they tell me is that, look, innovation is key. Of course, the deployment of real-time, up-to-date technology, and they're beginning to see remarkable results as far as the bottom line is concerned.
So it's been a key driver of banks' numbers since last year, and we did publish a report as well, just trying to track the trend on electronic banking income and try to figure out what the outlook is. And I think if you look at Zenith Bank's results as well, we saw strong growth in e-banking, fees from electronic products, and engaging with the management as well. I think they were comfortable and positive about strong growth coming from there going forward. And I suppose if you think about how you make payments as well, and I suppose one interacting with your bank through either through internet banking or through mobile apps, and also how you make payments as well in terms of paying your bills. I think there's been a far stronger shift to electronic payments, either through POS and then also if you think about in the past how typically you'd go to a vendor to buy recharge cards, but now it's all through your phones.
Yeah,
so I think there's clearly been positive trends in that. I suppose the question now seems to be with the payment service banks, do we see pressure coming to banks?
Do you see that happening? I mean, is that a real? Should we be having those conversations? I
think it's real. So even though banks will try to push the conversation to the win-win situation, whereby you'd argue that they have the infrastructure to go to the unbanked, bring them into the banking system, and then banks could offer treasury services and also on-lend to that segment of the market that is excluded. But I would also argue that, so if I think about myself as an individual, as an example, and option, so if I have an option to use a payment service bank through my mobile line or a bank, and if services are cheaper, I'd rather look at it from the angle of cost. And I suppose it's also a function of risk as well. So some would argue that because of the risk that might be involved, they would rather stick to an institution that they know. But I think the risk is there.
Well, I mean, that's definitely a point. It's something for the banks to think about. Now, for the deposit money banks themselves, I was just thinking, it would appear that all of them, I mean, I guess it's safe to say that, can make the necessary investments in the technology that they need to advance their, online payment channels. So I'm asking, what is going to set the winners, maybe not winners versus losers, but what's going to set that the bank that could take the lead, what's going to set it apart from the others? If they all have the money to invest in AI and the rest of it.
Yeah, so you can maybe quality of service, also marketing as well. So if you're able to create the right brand, I suppose that helps as well. So I think those two, I would argue, will set one apart. And if you're able to reach out, or if you already have a wide...
As customer-centric as they can be versus the other banks. Now, let's talk about, still in this report, credit to the private sector. Now, these two sectors that had the highest credit, as far as credit to the private sector is concerned, was oil and gas, which received 3.5 trillion in Q4, and manufacturing, which received 2.2 trillion. Now, obviously, we know that banks usually, the traditional sectors, oil and gas, power, but, I mean, just looking at manufacturing, I'm thinking that that's quite encouraging. But I mean, there's the issue of, at what rates, and I don't know. Let me let you talk.
I think if you look at the manufacturing sector, you'd argue that it's the usual. So if you think about all the large consumer companies, they all fall into that manufacturing space. So I think it's still a function of banks still maybe lending to sectors they understand and names that they will argue are low-risk names.
Low-risk, trustworthy to an extent.
Yes. So, and I'd argue also that they are names that should be able to still push for the lowest or the most competitive rate as possible, just because they're seen as safe names to lend to. I think the question really, if you look through that report, is exposure to agriculture, just 4%, in spite of all the rhetoric from the federal government and strategy to push.
Now, speaking about agriculture, I was speaking to the DMD of Zenith Bank, talking about the bank's full year earnings, and he talked, and I asked him, okay, what other opportunities do you see, are you looking for, and are you looking to, or possibly in the pipeline for 2018 and 19? And he mentioned the agriculture sector, and I said, wow, I mean, that's a high risk, and I mean, across the value chain, what's the deal? And he said, you know, there's the opportunities that they're exploring. I mean, what do you say to that in terms, I mean, for a Zenith Bank, for instance, and a couple of them, others, tier ones, who are actually looking to that sector?
No, I suppose it's also to think of what their customers are doing. So you're saying more backward integration. So because of the challenges we've had, suppose from the FX issues and the currency devaluation as well, and then the central banks push to restrict or reduce access to FX for a few items. You've seen a number of these manufacturing companies try to go down the value chain, from the flour mills and Dangote sugar, trying to set up sugar plantations and so on, and then the individuals going to rice milling as well. So I suppose that's where the banks are looking at. So it's really still more the large scale players, and not necessarily the smallholder farmers.
I think we have about 2 minutes left. Let's quickly talk about earnings. So far, like I said, we've only had Zenith, and it was quite interesting to see the cost containment, you know, in the books. I mean, the reduction in cost of risk, cost of funds, and NPLs and impairment that was brought down significantly last year. Speak to that point. Is this a sign of, can we expect this? Is it a sign in terms of what the other banks are going to present when it's time?
I won't be surprised, because I suppose for us that's been the driver of earnings positivity, I would argue. Right. So particularly when you think that the top line has been either stagnant or shrinking, most banks have been pushing for efficiency. Also, you're seeing reduced loan loss provisions ratio, because you've had periods of high impairments. A number of them seems to have taken that hit, and you're now seeing that low base effect coming through that. I think with Zenith, it's been the high cost of funds. You've seen that roll off as well. I think with the smaller banks, you might not see it happen as easy, just because of how their own balance sheet is structured. Yeah. But I suppose if you also look at the report published by the NBS as well, you've seen improved asset quality. So NPL ratio has reduced from about 16% to 14% to about 11% for the sector in Q4. So the numbers are also showing some improvement in asset quality as well.
Okay, Muyiwa, thank you so much for talking to us today. We appreciate your time and your share.